I'd like to welcome everyone to the Michigan Investor Group, and just really grateful that you guys are joining us this evening. It's it's always good to see some of these faces and names, and just appreciate you guys take some time. Not much of a surprise, but tonight, again, we're going to be learning about some of my favorite investment topics and talking about investing in the asset classes of mobile home parks and self-storage facilities. And our agenda, like normal, is we'll have a little bit of an introduction of our guest speaker, and then Mark will give us a presentation, have some Q&A, and should be a very informal night. About a year ago, Mark joined us for the first time on a similar topic, and so it'll be good to kind of touch base on that fund that launched a year ago, and then talk about this new fund. We'll be wrapped up by 8 p.m. So that's your time commitment, 1 hour tonight. So just to rehash for the folks that didn't join us a year ago, I actually met Mark in 2018, and that was when I was starting to do my research on the mobile home park industry. And I was just reading everything I could find and listening to podcasts and contacting people that I read about or heard about, and Mark was one of those folks who was kind enough to spend time with me and help me learn. And then we kept in touch over the years. And then in 2020, we actually started talking about some things in detail, because I had gotten some experience investing in mobile home parks, and we were trading notes and talking about different operators and projects, and then that built up into actually partnering together. A year ago now, March, I actually helped Mark raise money for the SMK Alternative Income Fund 1, and then and so I'm doing that again this year, this spring, helping him get the word out about Fund 2. So a little bit of background about Mark. Mark is the co-founder of SMK Capital Management, and he has over 15 years, maybe 20 years, close to now, of real estate investing experience, starting with some residential real estate he did personally in California, in Florida. Mark is always analyzing investment opportunities, and he's brought out over 40 real estate investment partnerships for limited partners and passive investors to invest in over time. Prior to being independent real estate fundraiser and investment fundraiser, Mark was the vice president of a retail distribution firm, and also worked as a financial analyst at a Fortune 500 company. And Mark enjoys spending time out in the Oregon wilderness with his wife and son and daughter. Like I mentioned before, Mark was one of the first folks I talked to about the mobile home park space. And I feel like I've just been very aligned. I feel like I'm very aligned, or we're very aligned in the way we think about investing in recession-resistant, tax-efficient, cash-flowing, and conservatively underwritten properties. And then just finally, I just want to make sure everybody knows that I am participating. I'm helping Mark raise money for this fund, so I do stand to have potential financial consideration down the road if we're successful in raising some investors. So I just want to make sure everybody knows that. Don't want anybody to be surprised. And that's about all I got for my intro. I'd like to ask Mark to share with us again what he's been working on.
Sure. Yeah. Thanks, David. Happy to be here, and great to see some more familiar faces. Appreciate the intro. I'll keep it kind of short, and happy to just keep it light tonight and open it up to Q&A at the end. But as David mentioned, I've been investing in real estate. It's not quite 20 years, David. I'm not that old yet, but we're getting close to it. But in many asset classes over the years, I was recently looking, I think it's about a dozen different real estate asset classes. And we really started focusing heavily on what we found to be some of the best risk-adjusted asset classes about 5 years ago, just narrowing it down more from the 12 to mobile homes and self-storage, and some apartments are really our top and have remained the top favorite asset classes for us for, again, over 5 years now. And so we focus on these asset classes because we've found their resilience through different economic cycles, downturns, volatility. We found consistent demand from users, residents, a huge spike in demand from investors who were typically selling to down the road. And so we've just fell in love 10 years ago, started investing in mobile homes and self-storage, and today they remain at the top of our list. So what I'd like to do today, I think, David, is we'll dive in. Let's talk a bit more about, we'll start with, trends in these asset classes. What's been going on? We created a recession-resistant fund in 2018. It combined our three favorite asset classes together. And we did that in kind of an anticipation of a potential correction, a potential recession, obviously. And so we fast forward to today, and our thesis has been tested, right, through COVID, and we are sitting here and discussing it. So we're going to go through some of the trends that we've seen in these asset classes, why we still love them, and then talk a bit more about our alternative income fund too. So before I start, just make sure you can see my screen and the mouse moving here. Awesome. Okay. So we'll dive in here. Our fund is a combination of both mobile home parks and self-storage facilities. We're focusing on diversification across both asset classes. Diversification has been a big part of our strategy and thesis for 12 years now. We believe these asset classes have a really good likelihood of performing very well over the next 10 years. And so we'll dive in. We're projecting 15 to 19% average annual ROI and 7 to 10% average cash on cash net to investors. All right, so as I mentioned, it's an opportunity here, a fund that we're going to be diversifying across both asset classes. The objective is to invest into growing portfolios of mobile homes and self-storage, high diversification, cash flow, and growth. And we're spreading our capital across assets, regions, and operating partners. We've already identified and we'll be focusing on 2 best-in-class real estate operators with active portfolios that we'll be investing into. They focus on acquiring, improving, optimizing both asset classes. And a big part of our thesis has been for a number of years and remains today is value add across both asset classes. So we're coming into these properties, improving them, making them nicer, making them improve operations financially, grow net operating income. And there's a lot of levers we can pull in each asset class to grow net operating income rather than, of course, just waiting for the market to continue to appreciate. Reducing expenses and other measures. So we'll dive into those in a few minutes here. So a summary of some key investment benefits. We're a professionally managed fund focusing on capital preservation with downside protection. We're combining lowly correlated recession-resistant asset classes into a portfolio for passive investors. Again, diversification. And we're targeting assets that have current income and the opportunity for appreciation. We'll dive into that a little bit more in a minute here. And we're really trying to always create an attractive risk-adjusted return and wealth creation. We found that these asset classes and a fund strategy like this is just a really good hedge against inflation through asset valuation growth, income growth from rent increases and expense reimbursements, depreciating debt, where essentially $1 today is worth more than $1 in the future. And you've got tenants at both asset classes that are less price sensitive compared to other asset classes. We also have favorable tax benefits, accelerated depreciation, and cost segregation, which flow through to investors. Let's quickly review some financial projections, and then we'll dive into the details of the fund. So we have 3 class shares for investors, starting with a $50,000 minimum for Class C, $250 for B, and $500 for Class A. You can see the preferred return, which accrues annually. It's essentially the cash-on-cash return that investors need to earn each year before we, the manager, participate in any of the cash flow or profits from the fund. And the split above that preferred return increases with each class share as well. You can see the average cash on cash, which is essentially the rental income over the life of the fund while we're holding. And then you can see the equity multiple. We're looking to double money in Class C and a little bit more than that, of course, in Class A. And the average annual ROI, again, 15 to 19%. That includes the proceeds at the time of sale in addition to the cash flow while we hold. We do have founders shares available, which is a higher preferred return for the life of the investment for the first 750,000 invested. Okay, our asset management fee. This is an annual cost that we incur at the fund level that is paid to SMK for managing the fund, distributions, updates, reporting, etc. That's based on capital invested. We have a one-time acquisition and disposition fee of the same. And the investment term is 5 to 10 years. And we're projecting that a return of principal and capital will begin in years 3 through 5, when some of the properties at the fund level will be refinanced and some of them might be sold as well. And so we'll be returning principal and then holding for cash flow afterwards. We do investor distributions quarterly, and you can see the projected annual cash flows net to investors here. They start at 3 to 6% in year 1 and 2, and they're increasing from there forward. This is just a direct correlation to the value add strategy. Typically takes 2 years or so to execute on the value add plan, to turn the rent roll, and to execute all the upgrades and repairs and renovations that we're doing at the assets to start to see higher cash flow. Let's dive in and talk about the mobile home park asset class and why do we love them? And I'll go through this somewhat quickly. I'm sure a lot of you are quite aware of the benefits of this asset class, but essentially we have a very consistent demand for affordable housing. We see this as a nationwide problem, and I have yet to find a solution that I think could solve the problem. We have a lot of people looking to live in mobile homes. It says here 17 million people live in them currently. We've also seen a trend for a few years now, a lot of retirees downsizing and looking for affordable options as well. Limited supply. This is a very unique characteristic of the asset class. It's just very hard to build and create a new mobile home park in a desirable area. So very low barrier to entry for new development. Tax benefits. We love the tax benefits here. You can do accelerated depreciation, 15-year depreciation schedule versus 27.5 for other types of real estate. So market inefficiencies, you got a lot of mom and pop owners. This is something that we see in both asset classes where they're typically not owned by what we would call institutional investment groups. That leaves a lot of meat on the bone to operate them more efficiently, improve management, improve the parks, put more capital into them, and grow the net operating income. And then unique business model, most mobile home parks that we're focusing on are typically renting the land to the residents who own the homes. That often will result in a pride of ownership, lower maintenance costs. You don't have to pay for repairs and maintenance at the homes typically when they're owned by the residents. And that reduces expense ratios, of course. We do see a lot of high resident retention. Mobile home, and David, you know this quite well, but not very mobile. They're quite expensive to move, 5 to 10,000, depending on where and how. But lot rent can be anywhere from $200 to $500 a month, and so not a lot of people are spending 5 to 10,000 to move the home. It's difficult to do. And actually, there's some data out there: 90% of mobile homes are actually never moved, and so it's a pretty interesting situation that's created once a home is in a lot. And then you see a lot of stability and predictability through lot rents continuing to grow even through recessionary periods. Let's talk about self-storage. So the average cost last time we checked for a 5x10 was around $84 a month. So it's a high tenant retention. You don't get a lot of people coming out on a Saturday to move their stuff out of a storage unit into another one to save a few dollars a month. And so that's a positive of kind of creates a more of a longer term tenant. Average tenant duration is 14 months and 46% stay between 1 and 10 years. My father is in that data point. He's had a self-storage facility for, I think, 8 years now. And so short-term rental rates, this is another benefit that correlated to one of the aspects of self-storage that we love during inflationary environments. You've got a month-to-month lease and contract, so you can raise the rent with 30 days notice. That's very quick. I think the only other asset class that's faster is probably hotels. And then you've got rental increases of 6 to 12% or so are common due to the dollar value of what that percentage is. Just assume you're at $100 a month. If you're going up 10%, again, not a lot of people are going to jump ship for $10 a month. And historically, it's had one of the lowest delinquency rates of all real estate sectors. There's a lot of data going back through multiple cycles. This is one of the reasons I got attracted to the asset class personally. It was in about 2010 or so. I was trying to figure out, personally, what should I invest into that has done well through the recession. And I was already in a lot of fix and flips and apartments and dove into self-storage and mobile homes at the time, trying to find a safe place to invest. And what we found was that these asset classes did very well, all things considered, during the recession in 2008 and 9. And there just wasn't a lot you could point at back then and say that about. And so they've proven themselves then, and they've proven themselves again through COVID, which we'll dive into more in a minute. Low overhead, operating expenses, you don't have, assuming they're drive up like you see in this picture here, you don't have, utility increasing, going up, plumbing, electric, gas, etc. So low operating costs and easy to maintain, and can often require minimal staff. If you do staff, not everybody does. Some of them are essentially virtual kiosks nowadays. But those that are staffed, you can see 2 full-time employees for 1,000 units. So we talk quickly about the lower capital expenditures. You can just see this chart here kind of pointing to that compared to some other asset classes. Again, this just helps increase yield and profit, having lower expenses. And this is a chart, just love to look at this. It goes back to 1998, you're looking at same store NOI. This is Sam Zell's Equity Lifestyle Properties, largest owner of mobile home parks in the US. Essentially what you're seeing here in orange is how their portfolio has maintained positive net operating income in all quarters back to 1998, even through recessions. So it's just a really good example of how this affordable housing option remains resilient through economic downturns. And so we like to show this. This is updated through Q2 of 20. We update it just about every year now. So that's the latest that we've got, but it is a robust chart that really shows the resilience here. Okay, here we're just looking at mobile home park rental rates and occupancy trends. This goes back to 2007, so you can actually see how stable the occupancy and rents were during the recession, and pretty much up and to the right since then. And so this is, again, another point that we love to look at: predictability, consistency with rental income. And again, as long as you're being fair, to your residents, then the turnover is usually very low. Going back to some of the prohibitive ways that these mobile home parks may be structured and how cost inefficient they are to move them. And this is self-explanatory, guys. You got just a long-term chart here showing demand for self-storage in the United States. This goes back to 1987. And so I think it's roughly about 1 out of 10 US households today use self-storage. So more recently, self-storage has experienced a lot of new construction, and this has resulted in a lot of markets suffering from oversupply. This is one of the biggest risks in the self-storage space. They go up quick, and they're often one of the lowest cost development real estate products that you can put up. And so we saw a big run up going from about 2016, 17, and then plateaued in blue here in 18 and 19. And it's been going down steadily since, which is a very good trend to get behind today. And then you also see the vacancy rates for storage in orange. And they're at the lowest level on record. And so we just feel some of these data points continue to validate our thesis that this is one of the best asset classes to be in today and a great time to get in. Let's look at some of the performance through COVID for mobile homes. We like to look at 2020, right? 2020 was peak unemployment, middle of the year, Q3 in the United States. Everyone was at home. And so that's a good time to look at data and see how did things do. And so what we saw, mobile home parks at that time, Green Street came out shortly after the end of 2020 and 2021 and noted that their expected, that the change in valuation was the highest amongst all real estate asset classes. So in 2020, we actually saw the valuation of mobile home parks go up 12%. Well, there's a lot of negatives on this screen here. As you can see, a lot of stuff went down, and self-storage was pretty much flat. And so again, resilience during what we think was the peak recessionary time period in the US in 2020. Now, if you look at the same chart, the end of 2021, going back 12 months, you can just see some pretty alarming growth here as far as valuations and what the asset classes did in 2021. And so a lot has changed, but today we see this as the resilience, and a lot more people are interested in these asset classes for many reasons. But if you could think about equity groups that used to invest in office and malls and retail and lodging, that those asset classes and those sectors have been hurt, and a lot of that money has been moving into what they consider to be safer real estate alternatives. And then again, looking at September of 2020, this growth chart was published by Green Street Advisors, essentially projecting 5-year IRRs for both asset classes amongst others as well. And so you can see that they continuously have some of the best projected outcomes. Now, this is another chart from Green Street. They track the projected new supply of each asset. You can see mobile homes has and remains flat. It's just not even on the chart, and no surprise, nobody's really building malls anymore as well. And so pretty relevant here, though, is what we're looking again for is what is storage doing as far as new supply. And this goes out till about 2025. So you can see very little projected growth over the next few years. So we find that to be very important today, where we're getting into assets today before potentially there's an increase in supply. And that's a thesis that we're looking at closely across all our asset classes. An increase in supply in a short period of time can cause markets to shift. And so we're very much cognizant of that and watching out for it. All right, so let's talk a bit about our fund. We're going to be investing into 2 established and growing portfolios with separate operating partners. And before we dive in, I can't stress enough, but our operating partners are one of the most critical aspects to success. Their role is to acquire the properties, execute on the business plan. And so what we do is we focus on building relationships and partnering with operators that have an established team, both in the back office and on the ground, handling day-to-day operations. We prefer vertically integrated firms with in-house property and asset management. Allows us to capitalize on some economic efficiencies. So let's review here what we're investing into. So we're going to be investing into a portfolio that already consists of 5 mobile home lots and mobile home parks and 13 self-storage facilities. This is our first portfolio investment, and it provides us with immediate and significant diversification across 1,000 mobile home lots and 6,000 self-storage units. You can see the states highlighted in blue. And as of the end of Q3, the portfolio had raised a little over 90 million of equity. It deployed about 88, and now they're adding another 30 million to fund new acquisitions in the pipeline. And so The business plan here is to be some of the last capital into this fund that is already established. They've got a bunch of acquisitions in the pipeline. They're planning to close this opportunity to new capital, probably within 30 days or so. And so we're going to be raising capital into this portfolio and investing into it. Now, with our structure and relationship with our operating partners, we've been able to earn more favorable terms for our group, including a higher preferred return and a higher split above the preferred return, just making the economics quite favorable. And then it's also good to note here that our firm and our family already have a 7-figure plus investment in this fund. And so we've been tracking it, we're invested in it, and we wouldn't be talking about it if we weren't quite excited about the future here. Let's go through some of the highlights. 90% of the assets are sourced off market, and I'll share with you kind of how they do that in a second. Our operating partners co-invest around $4 million of their own capital into the fund. It's something we require for all of our operating partners. And as of the end of 2021, the fund had a very low loan to value of just over 15%, which really provides an opportunity to increase future investor returns. They have a new line of credit with KeyBank that they just secured. And that credit facility has a max loan to value of 65%, so pretty conservative debt here. And it's a variable rate today, roughly around 3%. So we're excited about that. It's going to be a great tool and use of leverage for this portfolio. Collections and occupancy as of Q3 were 90 to 93% across the portfolio. So this portfolio is designed to provide income and growth. There's a lot of value add measures, but when you're talking about an occupancy this high, it's already producing free cash flow. So we're excited about the income and the growth aspect here. We have some numbers here. Basically, our operating partners underwrite each deal to provide at least a 20% or so IRR and a 2.5 equity multiple to the fund. All right, so we talked about operating partners, and one of the things we look for, especially today, there's a lot of new entrants into this space, and there's a lot of operating partners out there. We're always looking for a competitive advantage. What makes them unique? What are they doing that no one else is doing to give us a better risk-adjusted return, right? That's really what we're looking for. And so this operating partner for the mobile home and self-storage portfolio have one competitive advantage is their sourcing. How do they get deals? And so if anyone's tried to buy a house or looked on realtor.com or a rental these days, you'll probably see in most markets there is not enough supply, and there's a lot of people chasing few deals. And that's the same typical story that we've been hearing for a couple of years now across most of our asset classes and most regions. So for a little over 5 years plus now, our operating partners here have built out their acquisitions team. It's in-house, 7 full-time people, and their job is to source off-market deals and do that through mass marketing, cold calling. They're calling mobile home park owners and they're calling self-storage owners all day long. So for example, they had targeted a area of Kentucky that they were looking to expand their self-storage portfolio in. They sent out 635 texts to owners in a matter of minutes, and they got a 13% response rate, which is quite high. If anyone's in the marketing business, you'll probably appreciate that response rate. And if you look some more at the numbers, they're making over 130,000 calls a year, okay? And they made 120 offers and got 30 accepted. And so this is the kind of thing that we like to see where we can essentially potentially build a moat around our acquisitions strategy and create a pipeline of off-market deals, hopefully for mom and pop operators that are managing to occupancy, not focusing on bottom line revenue growth, and are most likely not completely aware of the competition out in the marketplace and possibly get great deals. And so this is an area that we really like to see with this operating partner. Let's look at a case study. So In October 2020, our operating partners sold a pair of self-storage facilities. And we like to look at this because this is, again, height of the pandemic, right? And so this is in 640 units in Crescent City, California. It created a lot of value in a relatively short period of time. There's value add strategies, management enhanced performance at the self-storage facilities. What they did is they increased the rents to market, and they added 69 new storage units. And they essentially bought it off market, like we discussed, direct from seller. And they were able to exit the investment, really great returns. And so let's review here. They bought it in two properties for $2.5 million in 2016 and 17. Sold it for $6.6 million in October of 20. They grew NOI by $175,000 per year, which is quite substantial for a $2.5 million acquisition. And so the project level IRR was over 80% and equity multiple of over, 3.6. So very, very outstanding returns. Again, their focus is on finding assets that are mom and pop owned and have a lot of growth that they can come in and implement. Let's talk about our second portfolio investment. The second portfolio is a mobile home park portfolio. It already owns 12 mobile home parks across, that should say 7 states. And the portfolio provides investors, again, same concept here, immediate significant diversification. And they've got more acquisitions in the pipeline as well. And this portfolio will most likely also be closing to new capital in the next couple months. Our operating partners are co-investing around 3% of the total equity from their own personal investment. And the strategy here is a lot more of a value add opportunistic play. And so that we're projecting to be providing cash flow distributions after 18 months and a return of principal by year 5 through refinances and sales, and then holding the assets for cash flow. And so a big part of our risk reduction technique across SMK and what we try and do is grow value and then return principal to investors, and that just reduces risk, right? Especially if you can do it in a very large way. Assuming you have 100% of your capital back and you still get free cash flow for years to come, that to me is what I would say an ideal investment and one of the best options out there if you can create it. So that is a big part of the strategy here. Again, we were able to negotiate more favorable terms through our relationship here, and we do already have an active investment of $500,000 in this fund. So same concept, we're putting these together, we're already invested in them, and we want to add a little more capital to these portfolios before they're closed. Some highlights here, guys. Again, they're focusing on opportunistic value add mobile homes, and that should yield to higher projected growth. The average year 1 cap rate of the current properties in the fund is over 9%. Very strong going in basis there. As of the end of 21, the fund had a loan to value of 70%, so pretty conservatively financed, all things considered. And the cash flow distributions to existing investors are beginning about 1 year earlier than projected. And so based on that alone, we're pretty excited that the fund thus far has moved faster than projected. And so again, we're always looking for conservative underwriting and trying to meet or beat the projections. And at this point, based on the timeline of 18 months, the earlier investors in this fund, it's only been open for about 8 months. And so much sooner than the 18-month mark, but we're still setting that expectation today for new capital coming in, just to, of course, be conservative and remain that way. And you've got a pretty interesting opportunity here. This is something that we've been looking for a little over a year and a half now, where we can source opportunities, where we can invest into properties that were acquired 6, 12, 18 months ago. And that allows us to potentially step into any potential appreciation that we've seen since they've acquired. And That can come from natural market appreciation, like the previous chart I showed you. It can also come from value add. And so this portfolio does provide that opportunity, and we're excited about that too. It's definitely something we're looking for today. Lastly, an important point here, there have been no rent raises at this portfolio yet since they started acquiring it. Effective April 1st, there's going to be a rent raise across the portfolio going into place that's going to add $57,000 per month to the net operating income. Again, this is a very, very positive data point and trend in this portfolio. We're really excited about this. And I think just to add a little context here, because that seems like a pretty high number, this is over 1,000 lots. And so it's between $25 and $50 per month per lot, give or take. And so we always try and make sure that our operating partners are ethical and not essentially gouging folks. And we've seen that in the industry. We tend to just avoid folks that operate that way. Let's look at an example. This property is in the fund, and in May of 21, it was acquired. It's 87 lot mobile home community in Alabama. They've seen some good progress already here. They have already basically turned over a lot of delinquent residents. The previous owner had a problem with collecting rents. They weren't able to enforce rules, and these guys have come in and implemented their management skills and techniques to already reduce delinquency by 50% since acquisition, which you can see in this chart here. This blue line is going down, has been dropped in half essentially since acquisition. So that's one good point about this park. You can kind of see the pictures and some of the renovations they're doing, but they've renovated the new office. They've paved the roads. They're renovating and infilling used homes. The business plan is really to increase occupancy from 67% to 95% by year 3, and selling homes to residents. They typically will do a rent-to-own program. And what they've done so far is today we have 57 paying tenants, up from 36 at acquisition. So pretty good growth in less than a year. 7 of 28 homes have already been sold through the rent-to-own program. Again, that's ahead of pace. We've got lot rent at acquisition was $250 a month. They were projecting it in 2022 to be $275 a month. Again, there's the $25 increase. And they estimated that by year 4, the rents would go up to $315 a month. But they're experiencing higher than expected demand. So the lot rent on April 1st is going to $310. And so you're talking about raising the rent, $60 a month, which wasn't projected to happen until year 4. And we're doing that, basically by year 2. And so again, we're quite excited about the progress we're seeing here. Purchase price on this park was $1.35 million in May. The price per lot of $14.6K. And the projected sale price, $3 million. And that would provide a project level IRR of 18.6% over 10 years. Okay, let's look at a quick case study here. This is the same operating partner. Now, a lot of people ask, how do you add value in a mobile home community? What can you do to improve the community and make it a better place to live and a better investment? And so this is a good example. In November of 2019, they closed on a refinance of its portfolio of properties. There's 2 parks. They're in Phoenix City, Alabama, just outside of Columbus, Georgia. The first was bought in April of 2018 for $900K. The second in June of 2018 for $2.2 million. And at the time of the refinance, the appraisal had a value of $4.4 million. So essentially, they doubled investors' equity in less than 18 months. It's great. How'd you do it, right? And so essentially what they did is they bought these parks from absentee owners, just out of state, not paying much attention to what was going on. And they came with 101 park-owned homes. And so essentially what they did, they had a rent of $200 a month at the first park without billing back any water or sewer charges. Tenants were not paying for utilities. And the second park was $250 a month. Now, the water and sewer charges, the second park, were $7,000 a month. And, you know, when I talked to the owner of the company, he explained it to me. He said, basically, every Saturday was free car wash day. And so people from all over town were coming here and using the water because nobody's paying for it. And so pretty big problem operationally that they solved, and they solved it by installing smart water meters at each resident site, and they were able to recapture about 70% of the water and sewer expenses, billing them back to the residents. They also paved the roads, put in a playground, a nice covered mailbox area, barbecue area. They really created a community. Again, this is a big part of adding value. And they raised the rents at the first park from $200 a month to $320 a month. The second one from $250 to $275. And so here's some of the numbers. Again, purchase price total $3.1 million, refinanced about 18 months later for $4.4. It's a 42% increase in value in 18 months. And a big part of the strategy, as I mentioned, is to sell homes, rent to own strategy. They've been able to take the 101 homes that were park owned at acquisition, and now there's only 9, and most of those were sold through the rent to own program. So a great example of what we would call a little bit more of an opportunistic play here, and doing it in a very attractive time frame and an ethical way where the residents are actually benefiting, of course, from having this new ownership and new management in place. So a couple questions I want to share. You know, we've got a lot more information on our website. You can log in and listen to interviews with our operating partners. There's a lot of information. I want to kind of keep this a little bit short here and close off in a second, but folks always ask, when will distributions likely begin? And so this FAQ section is out of our executive summary, which you can view on our website. But essentially, we're sharing that we anticipate that initial distributions will occur after the close of Q4 2022, if not sooner, and then quarterly thereafter. And then people ask, of course, when will I begin to accrue a return? And so we're just telling folks, you know, we're going to notify everybody once the preferred return starts to accrue. And we just tell people to plan for a period of, 1 to 3 quarters or so from the time of investment for the preferred return to begin fully accruing. So it just allows us to raise the capital and place it into these 2 deals, and potentially a third, which I'm talking to another operating partner this morning about, but that's essentially a quick update on preferred returns and distributions and timing there. And our financial projections have accounted for this schedule as well. So I'll pause here, guys. I appreciate going through this with you, and love to just answer any questions that come to mind.
I had a couple of questions, Mark, I could get the ball rolling with.
Sure.
So how similar is this Fund 2 to Fund 1 that was a year ago, March?
It's very similar, David. So Fund 1, we invested in 3 operating partners deals, and 2 of those 3 are the same 2 here. And so that's something we're just telling all folks. If you're in Fund 1, you want to look at that, right? Do you want to increase your allocation into these assets? And if you do, this is a great opportunity to do that. And we have some folks that do want to do that already. And so that's a good question, David.
We like last summer, I'm not sure who recalls this, but we actually had a meeting talking about investing in a different investment opportunity as the part of the last money in. And it sounds like this timing of this fundraise kind of fits that profile too, as being some of the last money for these funds.
Yeah, that's it. It's a strategy for us when we're looking at investing in portfolios, David. We often would prefer to be the last money in. There's some benefits there. It's a lower risk decision because you can see the assets, you can see the performance, you can see how they've been doing. You have a pretty good understanding of what they're buying, how they're operating, the distributions and the projected returns. So it's definitely last money in for me is the way to go on portfolio investments.
And because 2 of the operators in this deal are from Fund 1 also, how's Fund 1 performing compared to your projections over the first 12 months.
Yeah, right in line with projections as far as cash flow distributions go, David. And then, I just shared a couple more updates here on where things are going on this most recent portfolio, providing cash flow sooner than expected. And so I anticipate, again, we're getting a distribution at the end of Q1 from this second portfolio because we're actively invested in it. We weren't anticipating or projecting that until the end of 2022. And so I anticipate this year that our cash flow will probably be higher than projections.
Hey, Mark, with 10,000 baby boomers retiring every day, you indicated that nobody's building new mobile home parks. Just as a wild hair, could somebody build a new mobile home park and make money doing it?
Yeah, you can. Here's what, and I shouldn't say nobody. It's very hard to do and still provide an affordable housing option, John. That's the key to it for me. So I've seen it done a few times. We've actually looked at some investment opportunities in Washington State, where another group was building a mobile home park, and another opportunity in the state of Florida, where they're building a mobile home park. There's an attraction to that, of course, John, right? Because you would assume there's a line of people waiting out the door to move into it. A couple hurdles that we see today is supply chain issues, getting the park enough homes to be able to sell them, number one. Number two, what you end up finding is the cost of land in attractive areas is a bit prohibitive to being able to provide an affordable housing solution. And so both of these examples that I'm sharing with you, Washington and Florida, where we've seen this done recently, the homes were like $250,000 when you're all said and done. And so could that be an option for a retiree? Sure, absolutely. But we're focusing more on affordable housing, where the lot rent, typically, like I said, not much more than $500 a month. So it's a different play there, John. It's hard to do it because of a few things. Well, we always point to zoning regulations. If you can find a parcel of land that allows for a mobile home community on it today, you're going to have to ask yourself, why isn't there one here already? As there's probably something there. And number two is if you don't and you're trying to rezone it, that's very hard to do. Most counties, cities would find tax income from that lot to be much higher through a different source. And so you actually are seeing some communities today are being demolished, and they're going to be building, a lot more of a higher income stream from them. And so that's also why the supply is flat or declining, is because for the few that are actually built and created, there's also a bunch that are taken away.
Thank you.
Sure.
Mark, I've got a question. It's all right. It might be unrelated, but does a mobile home park have to have mobile homes?
No, it depends, right? It depends on the lot owner. And I guess, let me ask a question before I answer. Are you saying, can the lots be vacant, or can there be something else on them?
Could there be permanent homes, traditional style homes, mini homes,
Yeah, it's a good question. I believe so. We don't typically see much else other than some RVs, Brad. And so that might be part of the answer too, is where you tend to see RVs, you tend to see mobile homes. I'll say this, for what we're looking at, we want to make the community nice. You want to have a nice curb appeal. You want people to pull in and say, wow, it's safe, it's clean, and lighting, security, all of that is important. If you have a shed, for example, and people living out of it, that kind of stuff, you might deter a quality resident. And that's the other thing.
Sure.
You're creating a community or improving a community. Community is all about people. And so you want to make sure that the residents respect the community, they respect one another, crime, theft, you name it. And so our operating partners are pretty cognizant of the look and feel of the community and what kind of homes they're putting in there.
We are seeing tiny homes. We are seeing tiny houses go into parks up in the mountains.
It's probably a great idea. I mean, you're seeing that tiny home revolution. That's essentially what a mobile home is. They're basically tiny homes, right? If you think about it. And so, yeah, that's another great option.
Yeah. Thank you.
I've always said mobile homes are tiny homes before tiny homes were cool.
There you go. That's good.
So Mark, when was the first time you invested in a mobile home park?
2012, it was in a fund, and I've been hooked ever since. Yeah.
Yeah. Yeah, they really, I've had my attention on them since 2017 or so, and they've done very well, and it's been the asset class that me and my family have invested in the most deals in out of anything else, and they're doing well.
Yeah, I'll say this. I was going to mention something just regarding some of the trends we've seen. Everything's gotten more expensive, guys, right? We all know that. Even mobile home communities, of course. Going in cap rates in 2012 were 10+%. Today, they're 4, 5, 6, 7%, depending on where they are. Obviously, depending on occupancy, depending on how much work they need. The second portfolio I noted, average going in cap rate is 9%. So it's really hard to find, really good priced mobile home parks these days without doing heavy lifting. So I think that the evolution for me as an investor is like 5, 6, 7, 8 years ago, you could kind of cherry pick, right? And there was a lot more meat on the bone on parks. And so today, things are tighter, margins are tighter, prices are higher. It's just a known fact. And so to reduce risk, you got to ask yourself, what are we doing here? Why are we buying this and not a apartment community, right? And the reality for me is I don't anticipate rents to go down. I don't know that we have a chart here going back 2007. They really don't go down, right? And so that's a big part of the resilience here. The demand for them, a lot of the communities, our operating partners tell us there's a waiting list for homes. And so you have so much demand. You've got I believe, a very predictable demand for these communities for the next 10+ years at least. And so it's just a little bit of an evolution. Although things have gotten expensive, we think that the value add play has not yet been, now's the time to do it. That's the reality for me. 7, 8 years ago, you didn't have to, right? You could kind of cherry pick a park and get same returns. But not a lot of groups are doing the heavier lift and value add. And so this has been a strategy for us for the last couple of years that we've expanded into in mobile homes. And we're just seeing there's a lot of low hanging fruit here. And David, if you want to add any insight here, but there are not a lot of operators that go in and want to do that much work. Let's just be honest. A major overhaul in a community takes time, takes a lot of effort, and a lot of operating partners will avoid them.
Yeah, I would agree. Yeah. Mark, what is the best way for people to kind of dive in is to, I'll send an email tomorrow following up with links and things, but if they go to your website, smkcap.com, then they can click on investments, and then they can kind of get access to your investment portal to get, I think Mark's got some really good interviews. He interviews both the operating partners, and you can hear them speak firsthand about their experience and what they're seeing out there, and some really good content, once you get into the portal and sign the confidentiality agreement and all those kind of things.
Yeah, it's pretty easy, David. We've got a button now. It just says sign up if you're not already an active investor.
Okay.
Once you do that, you have access to all the details.
Okay. Any more questions out there, guys and gals?
Another question, if you don't mind.
Sure.
Have you ever considered getting or accepting financial commitments over a period of time versus a minimum one-time investment?
Tell me how that might work, Brad. It's interesting.
Well, obviously you've got cash flow that you plan on returning in a couple quarters. What if that person, I'll just speak for myself, what if I'm not interested in the cash flow return, but I'm going to continue to pay $10,000 a month, whatever the number is over a certain period of time, over a 2-year period, versus just having $100,000 up front.
Clever. I hear what you're saying. We haven't structured anything that way, but I'd be happy to chat with you more about that, Brad, and see if there's something that makes sense, because it's a good idea, right? You're helping people get involved in a way that makes sense for them. And so,
Sure.
yeah, if you want to chat more, let's talk more about that.
Thank you.
Sure.
Can we talk a little bit about opportunities for refinance and, getting lump sums of cash back while keeping your equity in the deal?
Yeah.
I know that's one of the things that I don't think maybe people who are earlier to maybe the alternative investment space might not be too familiar with that, but you mentioned that could be a possibility in this fund in maybe 3 or 5 years. And can you speak to that a little bit?
Yeah. So David, if somebody asks me what's the perfect investment, right, which doesn't exist, of course, but if I had to define it, it would be one that I have no money into it and it still provides me income. And so there's no risk. And so how do you create that? You create it by acquiring a property, growing the value substantially, right? To the tune of 30, 50, 100% over a few years, and then refinancing, putting new debt on the property to the tune of the amount of the existing debt and the equity is paid off. And so all your investors get their money back, and you now have created a value that's high, and you have maybe 70, 65, 70% loan to the current value. And so you have no more skin in the game, you've got no more capital in the deal, but you keep holding it because it's producing positive cash flow and spreading the income to investors. And so that is a strategy that we love to see and try and focus on. It's hard to do. Otherwise, you'd never do anything else, right? And so that's the reality of it, but definitely a focus here today.
And again, I know we can't predict anything, but in 2021, we actually had 3 of our 2018 or 2019 vintage investments, that refinanced and got all of our investment capital back, and we're still making distributions. And so it's like, once you see it happen, it's kind of like he's like, okay, that's what I want to achieve.
Yeah.
So it's nice. It's interesting to see that our first partner and this operating partner has such low loan to value right now. It seems like that could make the refinance opportunity, I hate to say more. I don't want to say likely, but maybe more likely.
Yeah, I mean, definitely, David, right? 15% loan to value is not enough. And so to be able to still provide positive cash flow distributions, such a low loan to value it means the properties, of course, are pumping out a lot of cash flow. And so we're excited about that. I'll also mention that, like you said, once you see it and you actually have it happen, you say, oh, wow, this is what I want to do more of. And the other benefit of that is you take your initial principal off the table and you can go invest in something else, right? So you can compound that money over and over and really create a much higher return where you're still getting income and profits from initial investment, but now you've got your money working in something else too. So that's the rinse and repeat model that we like to see. Again, if you can do that, that's a no-brainer and a win-win.
Okay, well, it's 8 o'clock now, and I just want to say thank you to everyone for joining us tonight. And like I said, we'll have a follow-up email tomorrow come out with some links, but you can see Mark's information here too, and you can contact me if you want to talk about this at all, or just feel free to contact Mark directly also. And thank you very much for joining us again tonight.
Thanks, everybody.
Thanks, David. Thanks, Mark.
Bye-bye.
Thanks, Mark.
Thank you.
Thanks, David.
Bye-bye.
Thank you. Bye now.